Mondelez International is a global snacking food company that creates, distributes, and markets some of the world's most recognizable snacking foods. With operations in more than 80 countries and employing more than 80,000 people around the world, Mondelez International is a powerhouse in the global snacking food industry. They have brands such as Cadbury, Oreo, Ritz, Sour Patch Kids, just to name a few. Mondelez was created in 2012 when Kraft Foods decided to split into two separately publicly traded firms. One of them being the Mondelez International, which services the snack foods all around the world section. Since then, Mondelez has been on the forefront of the snacking food company, despite only being 9 years old. So when looking at the financial analysis of Mondelez International, beginning with liquidity and current ratio, Mondelez has a current ratio of 0.45 and 0.5. However, Mondelez current ratio is more than half as low as the industry average of 1.2. Mondelez's low current ratio demonstrates a weak ability to pay off current liabilities with current assets, and this does not look great for Mondelez. This is most likely attributed to the overall large amount of current liabilities compared to a smaller amount of current assets. For the quick ratio for Mondelez, Mondelez has a 0.31 and 0.33 quick ratio in 2018 and 2019, which is low compared to the quick ratio industry average of 0.80, which indicates that Mondelez has a very weak ability to use their quick assets, which are current assets minus inventory, to pay off their current debt. This again is due to a very large amount of current debt and liabilities compared to their net quick assets. Overall, Mondelez is illiquid. Their current assets are much less than their current liabilities, and their current and quick ratio are well below the industry averages, which shows a weak liquidity. This is most likely attributed to the high current liabilities and relatively low quick and current assets. So solvency, starting with the debt asset ratio, which showcases how much of Mondelez is financed with debt. So this showcases that Mondelez finances 58 and 59% of the firm's capital assets with debt, and the other 41 and 42% with owner's equity. This indicates a higher level of risk, as Mondelez has more debt than owner's equity financed. This debt asset ratio is almost right on par with the industry average of 0.6 or 60% of debt financing, which shows that Mondelez finances with debt just slightly less than those in their industry. So the equity asset ratio shows how much of Mondelez is financed with owner's equity. So this also showcases that Mondelez has a much higher debt asset than equity asset, showcasing a higher finance of debt than owner's equity. So Mondelez is just above par with their equity asset of 0.41 and 0.42 of the industry average of being 0.40. This indicates that Mondelez finances with owner's equity just slightly more than others in their industry. Moving on to the debt equity ratio, which showcases that Mondelez handles finances more with debt rather than owner's equity, with their debt equity ratio being 1.44 and 1.36, and the industry average being 1.5. This also shows that Mondelez is slightly less risky than others in the industry, as they finance less with debt compared to others in their industry. Solvency overall is Mondelez is solvent. Their total assets are much greater than their total liabilities. Their debt asset and equity asset ratios are right on par with the industry average, and debt equity ratio indicates less financing with owner's equity and more with debt. However, Mondelez is still less risky than others in their industry. For the total asset turnover and activity, which measures how efficient their total assets are in producing sales revenue, Mondelez is a total asset turnover of 0.41 and 0.40 in 2018 and 2019. This is well below the industry average of 0.55, indicating a weak ability to generate sales from total assets. This is most likely due to the large amount of total assets compared to a relatively small amount of sales in 2018 and 2019. For fixed asset turnover ratio, which measures the efficiency of fixed assets in generating sales revenue, Mondelez has a fixed asset turnover of 0.47 and 0.45, which is vastly below the industry average of 0.70, which showcases a weak ability for their long-term and fixed assets to generate sales for Mondelez compared to the rest of their industry. This weak ratio is due to the large amount of fixed assets compared to sales revenue for Mondelez in 2018 and 2019. Industry turnover ratio indicates Mondelez's ability to sell and turn over their inventory each year. In 2019, Mondelez had an inventory turnover ratio of 6.05, indicating they sell their inventory 6.05 times a year. This is exactly on par for the industry average of 6, which indicates Mondelez is just as efficient in turning over their inventory as others in their industry. Overall, they're inactive. They have an inefficient use of their assets, seen by their weak total asset turnover and fixed asset turnover ratios. This inactivity is due to a large amount of total assets and a very small, relatively, sales revenue. Their profitability and the gross profit margin ratio of 40% means that they have 40% of sales revenue is turned into gross profit. This is very high compared to the industry average of 30%, which indicates that Mondelez is more efficient in generating gross profit from their sales. This high gross profit is due to low COGS and relative to sales revenue. A net profit margin ratio, which measures Mondelez's ability to generate net income from sales as a percentage of total sales. So Mondelez's ratio is 13 and 15%, which is considerably higher than the industry average of 10%, which means that they are more efficient of generating net income from their total sales than the rest of their industry. So the return on asset ratio measures the efficiency of total assets to generate net income for Mondelez. And Mondelez has an ROA of 6% and 5%, which is lower than the industry average of 8%. So this low ROA is due to a considerably large amount of total assets compared to smaller net income for Mondelez, which indicates that their assets are not as profitable as others in their industry. So return on investment ratio measures the efficiency of their owner equity to generate net income for Mondelez. So their ROI is 13 and 14%, which is slightly lower than the industry average of 15. This weaker ROI is due to a considerably high owner's equity relative to small net income. Overall, Mondelez is profitable with strong gross profit margin and net profit margin ratios. However, their ROA and their ROI is lower than the industry average due to total assets and total equity being much larger than net income. Their market-based performance with their price earnings ratio with Mondelez, which is 23.83 and 20.53, which is considerably higher than the industry average of 10, which is very optimistic and a bullish opportunity for investors for Mondelez. The Mondelez's beta is 0.66, which means that Mondelez's stock variance moves with the market and is 0.66 times as risky as the market, which showcases a considerably less risky stock for Mondelez. And this is a very bullish opportunity and very optimistic, as shown again. And their market capitalization, which showcases the overall worth of Mondelez to investors. So Mondelez has a very high market cap of 82.69 billion, but this is very high from just June of 2020 with the 73.02 billion. This jump in market cap shows that there's a large growth of capitalization for Mondelez and is also very optimistic for shareholders. Overall, market-based performance is where Mondelez really shines. It's very optimistic and a bullish opportunity for shareholders to come and invest in Mondelez. This is no surprise as Mondelez is a very large international-based company. The overall recommendation would be lower current liabilities to improve liquidity, assess the efficiency of total and fixed assets, and possibly discard inefficient assets. This will improve activity. Address inefficiency in sales and marketing teams. This will help increase sales revenue, which will in turn increase activity and profitability. Then reduce expenses to increase net income, which will increase profitability. Thank you for your time, and I hope to see you later.